So Coal India's quarterly report came out yesterday. I'm going to check the reports now. I'm on the NSE portal for Coal India. Let's go through this one by one. So audited financial results of Coal India Limited for fourth quarter. Further, the board of directors in its meeting held on date had recommended payment of final dividend for financial year itna at 5.15 per share. So another 5.15 per share. If you look at the previous dividends, where are the dividend announcement? Yeah, so if you look at this corporate action, there were dividends issued. Oh wow. So there were dividend issued. So this was final dividend for last financial year, and for the financial year which just ended, that is March 25. They had previously issued dividends of 15.75 and 5.6, so that is 21.5, something around that. And additionally, they would be paying another 5.5, so the total goes up to about 27 rupees. So 10 times of that is 270. So if the share price comes down to 270, it would be at a dividend yield of 10%. 540 would be a dividend yield of 5%. 135, 405 would be dividend yield of 7.5%. And the current share price right now is 388. So if you divide 2015.65, so if you divide 15.75 plus 5.6 plus 5.15, total is 26, divided that by 388. So right now it is at a dividend yield of 6.8%, which is as good as getting an FD, right? The FD is paying somewhere in the range of 6 to 7%. 1 year FD is paying 6% interest. So rather than taking that, if I take the Coal India shares, I would be earning a dividend of uh, nearly 7%, and that is it has a history of that dividend for last 3 years now. So it's not just 1 year where they have paid that kind of dividend. So for continuously for last 3 years, they have been paying high dividend in the range of 25, 26, 27 rupees. And let's assume it will only continue to go up to 27 to 28, 29, 30 in the years to come. There is a risk of capital going down, but there is a chance of capital going up as well if the use of coal increases. And the way the global conditions are right now, I think coal and oil are going to be used massively in coming decades or two. Dividend would be paid within 30 days from the date of declaration. So these are all the subsidiaries of Coal India. I just want to go to the financial statement here straight away. So this is consolidated financial result. So they have their total revenue from operations, which is at this is in crore. So 100 crore is a billion if you understand that with. So this sales is 378 billion, or if you take in crore, 10 crore. So the total sales was 378 billion rupees compared to 368 for the previous quarter, and for the same quarter for last year it was 382 billion. So the sales has not grown. It's roughly at the same level from for last year, and then there's other income as well, so it's roughly at the same level. Then if you look at the cost of material consumed, it's once again roughly at the same level. Change of inventories, employee expense is slightly lesser this year. Finance cost, depreciation amortization, stripping activity adjustment, contractual expense, other expense. So the total expenses roughly at the same level. The total income and total expenses are roughly at the same level as last financial year. So this last row is for the financial year which ended in March 2024. This row is for financial year which ended in March 2025. So the total income and total expenses are both roughly at the same level. There's no growth in this company. The only thing which changes, so, so there was no growth for the last year, but if you look at the history for the last 10 years, it has roughly doubled. The sales has roughly doubled over that period. It's not a high growth company, but it's a high dividend payout company. But the thing is, with the share price itself is at such a low level that it can realistically only go up from here. If it becomes half, if the share price becomes half of the current level, then share would be selling at a dividend yield of 13-14%. And who wouldn't buy a share of dividend yield of 14%? What else do you want in life? So the chances of share price going down is low. At the same time, there's not a lot of upside as well. To be frank, if the share price falls by half, it would become really, really good buy. At the current level, with no growth, it seems a little fishy. Total profit is 4,469 billion for the year. Now, what is the market cap? Coal India share price. So 2.39 lakh crore. 1 billion is 100 crore. 100 crore, 1000, 10,000, lakh crore is a trillion. So 2.39 trillion is the total market cap. 2.39 trillion is the total market cap. 2.39 trillion is the total market cap. 469 billion. So 10% of that would be 239 billion rupees. Current tax 353 billion. Total comprehensive income, owners of the non-controlling interest, owners total comprehensive 347 billion. 10 times of this would be 3.4 trillion, and this is right now at 2.4 trillion. So it's not that bad. 35 into 2 into 5, 350 into 5 would be 746. So it's 1 by 6. So it's giving 1 by 6 profit of the share price. So if you check per share, it's 57 for this year compared to 60 for last year. 57 out of 388 is 14%. So it has an earning yield of 14-15% on an average. It's not the kind of company which will grow every year or it will grow rapidly, but it is a consistent dividend category, but it is in consistent dividend category. Statement of audited consolidated assets and liability. So now here, if you look at the total assets is 2.6. So this is billion, this is trillion, 2.6 trillion. So remember, the company itself is selling at 2.3 trillion rupees, and it has a total assets of more than that, that is 2.6 trillion. Out of that 1.6 trillion are non-current assets, long-term assets, which is property, plant, equipment, that will all go down in depreciation, capital work in progress, exploration, evacuation, intangible assets under development, financial assets for investments, loan and other financial assets, investment loan, other financial assets, deferred tax. So in total, it has a non-current asset of 1.6 trillion and then 961 billion of, I'm talking in rupees, not dollars, 961 billion of current assets. So we have inventories and then investment, trade receivable, cash and cash equivalents, other bank balance, other financial assets, current, other assets, all right. And of this, if you look at the liability side, it's only 647 billion. So about more than three times of this is equities. No, non-current liability, current liability. Wait, what? So we have equity here, non-controlling interest. So the total equity is 999 billion. Maximum part of the non-current liability is the provisions. You would have to go into the notes of the annual report to check what these provisions are. But it has 955 billion dollar of 955 billion rupees of non-current liability. All of a sudden, liability is much higher, and 647 billion of current liability. Total outstanding dues of creditors other than just other financial liability. So I was wrong. About 40% of the total assets are in equity and 60% are liabilities. Current liability is 647 billion rupees. Current asset is 961 billion rupees. So current asset is higher than current liability. But the company will take care of this. Let's check the cash flow from operating profits, profit before tax, depreciation, amortization, interest, sale of property, liability allowances, written off, of shipping activity adjustment, cash flows from operating activities before changes in following: trade receivable, inventory, loan, the current trade payable. The cash generated from operations is 410 billion compared to the profit of 472 billion, which is not bad. Then income tax, why was this not included? You've already paid. Yeah, but if you look at the EBIT, this will not be included. Net cash flow generated from operating activities 291 billion. That is 10% of the more than 10% of what the company is selling for. Now from investing activity, so from operating activity it is positive, so it is generating cash from operations. Then from investing activity it is negative, that means the company is not raising cash, it is actually able to deploy cash, which is a good thing. And majority of it is for payments of property, plant and equipment, so this is capex spending. Coal India has been doing a lot of capex spending of late. Cash flow from investing, from financing, non-current borrowing, current borrowing, payment of lease liability, dividend paid on equity, shares, net increase or decrease in cash, cash and cash equivalent at the beginning of, so total cash is 111 billion. So they have so much of cash lying around, 111 billion. Let's check this in their uh, balance sheet. So cash and cash equivalent 111 billion. So they have given certain additions to those financial results. They have given some notes here. So they have talked about the dividend here, and this is breakup of the recent um, any acquisitions which they have made in the middle of the year or new projects which they have launched. So they have given about pro rata revenue and income for that. Then we have dividend here. So there will always be issues like this. We don't have to worry too much about these minor issues. We don't have to look into their day-to-day operation. Just an overview of how much they are making on a quarterly result, how much they own and how much they owe to others, and if what they own will continue to increase over the year. The standalone part is not important for Coal India because Coal India itself is made of all of its subsidiaries, and so any revenue or income they make as a standalone is not a big portion of their overall revenue. Um, so you can see the EPS, the total EPS for the standalone part of the company is only 27 rupees. I don't even know what they include as standalone. I don't even know what they consider standalone, what they consider in the standalone results, because it is made up of all of its subsidiaries rather than having separate operations as a standalone part and then having its subsidiaries doing additional work. So it is Coal India is just a sum of its parts, it's not more than that. So on one hand, the total income, if you check here, EPS for last year was 57. Here it shows half of that is coming from standalone. I don't understand. I have no idea about that. I have no idea regarding that. Or this could be something else actually. This is the standalone part. So so I think maybe this other income is all of the dividends coming from their individual subsidiaries, and they take that as total income for Coal India as a standalone body, and therefore they don't have a lot of expenses for the standalone part of Coal India, and therefore half of the EPS is coming through that. Uh, Now I understand, and maybe they are paying a significant portion of this to the shareholders. So maybe Coal India as a corporate body, uh, as a standalone corporate body, does not keep any of the money it gets from its individual subsidiaries. It distributes roughly all of it as dividends. So now it makes sense. Coal India itself is made up of a number of subsidiaries, about 20, 15 to 20 subsidiaries if you go back right to the top. So here we have this 12 subsidiaries here, and then step down subsidiaries are till 19. So in total it has 19 subsidiaries, and then 1 2 3 4 5 joint ventures. So what all of these companies do is they run their individual businesses. They have revenue coming in and certain set of expenses, and at the end of the year they, or at the end of the quarter, they make some profit, and from that profit they individually transfer some of it as dividend to the Coal India body. So that's why in the standalone part they get this other income here, which should be the dividend paid. I still need to verify this in their annual report, but I think this is what they are earning. The dividends coming from those subsidiaries, and because it doesn't have any operations of its own, it has very small amount of expense. A significant portion of that is just the employee expenses at the corporate body in your corporate offices and some other expenses. So this is their total profit before tax, which is very high. It's basically just the dividend minus their own expenses. But if you think about it, if you think about this tax here, so these individual subsidiaries made money, they paid tax on this, and they have after tax money. They transferred it as dividends to Coal India, and Coal India is paying certain amount of that as tax, and then they transfer rest of it to its owners, and then we pay tax from it. So the same income is being taxed thrice by the government, and government is majority shareholder of this company itself. So government is paying tax to itself at three different. So government is paying tax to itself on three different levels, thrice. Ah, weird. If you look at the balance sheet, majority part of it is investments, other financial assets, and majority of that is total equity, very few liability, non-current liability, could be pensions and other stuff related to this. There's not much to look into the standalone statement. It is more important to analyze the consolidated statement for Coal India because it's a conglomerate. Conglomerate because it's a conglomerate. Hmm, so this is all dividend income they are getting. So from operations they are making very small amount of money. This is in crores. So from on their own, Coal India as a body, as a corporate body, is making only 769 crore in the entire financial year. But when you add in this dividend, which is 16,238 crores, it swells up to 170 17,097 crores. Dividend received from investment in subsidiaries. See, that is the dividend income. So it's all good here. And they must also be paying if you look at the. So this is the dividend they received, and this is the dividend they paid. This is the dividend they received. This is the dividend they paid out. So in short, they roughly pay out every all of the dividends which they receive from their subsidiaries to its shareholders, which is a good thing. This is why I like this company. This it's already at a dividend yield of 7%. If the share price goes down, then the dividend yield could very well go up to 10%. It is right now selling at 390. If it goes down to 270, then the dividend yield becomes 10%. But let's say dividend will continue rising every year, just a little bit, not much, maybe by 4 5% or whatever. So from 7% in perpetuity, I can keep earning 7%, 8%, 9%. If the share price goes down, I can easily buy in the range of below 320, 330. If the share price goes up above 400, then it's not as attractive as before as the dividend yield comes down. So the share is already at a range where it's on the borderline of where I want to stop buying. I want to accumulate more of it at lower price levels in 270 to 330 range, and if it is below 270, even better. So this is done. That's the same document. They upload the same document under all the headings. If you see this, so this is all of this is for yesterday, for 7th May. Outcome of board meeting, dividend, the same document. General updates, the same document. Press release, same document. All of these would be same document. Okay, they have a presentation here. New subsidiary Coal Gas India Limited. This is a joint venture with GAIL. Monetization of coal washeries. Coal production has gone up by just 1%. I think their annual goal was higher than this, but they couldn't produce as much as they wanted to for the last financial year due to few different reasons. Maybe next year they will show some growth here in the total production. Then coal offtake has again increased by 1%. Offtake is what they are able to sell, or the other power generating companies or steel companies come and take buy their coal. OBR is overhead burden removal. So it's basically when they are mining, they not only mine coal, but they mine soil and other impurities as well, and they have to remove that. So in total, they had to remove over two thousand. So this is over 2 million cubic meter. This is million cubic meter. This is million cubic meter. So this, if you remove 1,000 here, it becomes over 2 billion cubic meter of overhead burden removal. If you look at the coal production, some have gone up, some have gone down. That's how it goes every year. Same in offtake, overhead burden removal, inventory. Okay, I'm not too worried. I've seen these things in the past. I'm not too worried for its day-to-day operations. It's a large company, well-established company. It has been operating for many years, and I don't see any reason to doubt its day-to-day operations. Coal production. See, in percentage, it looks like it has fallen considerably. But if you look at the total number, it's really nothing. It's non-existing, almost non-existing. Yeah. Almost. There's nothing to read here. The net sales is almost same. Net revenue from operations is almost same. EBITDA is almost same. Unless you see long-term trends over many decades or 5 6 years, there's nothing to analyze here. We own an asset in terms of Coal India. I own an asset in terms of Coal India, and you know how much coal it is going to produce. You roughly know how much coal it is going to produce for next year, how much revenue it is going to generate, and what is going to be its total income, and then what amount it will be distributing as dividends. So we have rough idea for all of those stuff, for all of those things. So there's nothing to worry about. With Coal India, I'm not going to have huge capital gains, but chances of capital loss is also minimal. If the share price goes down, then the dividend yield becomes that much more attractive. Now, if I was a person of high net worth and high net income, and I was paying a lot of taxes, then just the dividend income would not be very attractive. But if I have no taxes and I don't have to worry about taxes, then dividend income is not that bad. The only thing is I will be earning 6 to 7% of my money, the same as what I would be earning in FD. Now I will not become rich of that. 6 to 7% will not make me rich. Mm, Earning 20% on my capital will over time, 20 to 25% on my capital over time will make me rich. But until I find a company which is paying me 20 to 25%, I think a company paying me 7% should be a base. And now the other companies I invest in has to be better than Coal India. Has to be has to give me the security of income or capital gain. So either it has to have a growth in terms of sales and net income, and or it can give a surety of income there, income as in dividends. So they have broken everything down here. If you want, you can go through this. Okay, so EBITDA is 41% on net sales. As per Warren Buffett and Charlie Munger, EBITDA is BS earnings, bullshit earnings. Profit after tax is this much. Profit before tax is this much. Revenue is, this is billion, 1.4 trillion. So the total revenue is 1.4 trillion rupees, and the company is selling for 2.4 trillion. So CIL has attained a capex of Fitna. That is a lot of capex. So roughly half of its PAT is going in capex. Now will that capex help to improve? Now will that capex help to improve future profits? If it doesn't, then it's not really profit. So if you subtract this capex from profit for every year, then the free cash flow will go down substantially. I think the free cash flow will be in the range of the dividend yield, because if you subtract this, we are left with 160 billion. 160 billion of this will be more than 10%. It will be something in the range of 11%. So while their net profit itself is in the range of 25 to 30%, free cash flow will come down in the range of 11% here. Why is it more than total profit? It is also more than total profit before tax. Polymed. So we have this is just their note of publications of their annual and quarterly results in the newspaper. I already know, so I don't need to see this. What we can find here are other companies. So see, this is Polymed. PAT is 31%. Oh, that is interesting. Revenue growth of 21%. Total income from operations quarter ended, year ended. Let me check year ended. Oh, this is in lakhs. So 1017 billion rupees for this is in lakhs. So 110 billion is million, 17 billion. Net profit is 4 billion rupees. 3.3. So net profit for the year is 34. Now what is the share price for Polymed? Polymed share price. Ah, come on. P ratio of 86. I'm never going to buy a company at such high P ratio. It's earning 34 rupees in entire year for a share, and you have to pay 10 times of this would be 340. 20 times, let's say round figure 340, 350, 20 times would be 700. Who is going to pay 2700? I'm never going to make money that way. See where it was before all of this bull run came in. For long time it was in the range of 250. Now what happened all of a sudden? It's just a bull run. I don't know what is going to happen with the future of the company, but if it is, but let's assume in 5 years time the company will be selling at a P ratio of 20. So the share will go down one by share would be 1/4 of the current P levels. That means EPS has to grow by 4 times just to maintain this share price. Will the EPS grow become 4 times in 5 years? Double of double in 5 years? I don't know. I could take a deeper look into that, but for now, let it be. So that's all for this video. Thanks for watching.